Hello YouTube, Justin here. In this video, we're going to talk about how there might be a massive bear trap getting set up for 2022, maybe the biggest one so far this year. Why? We're going to be looking at monthly charts to try to understand how we're going to be closing out the month and the quarter, which is on Thursday. We're also going to talk about the wall of worry because there's always a reason to be scared, and there's no lack of reasons for this week. Again, the bears are being very loud, but they're not showing up on the tape. So where are they? Why? We're closing at highs on the day, on the week, on the month. Here we go. And why? Because there's no alternative. Let's jump straight in and see where the stock market is telling us we're going to go for the week ahead. If anytime you're enjoying the stream, please smash a thumbs up and subscribe to the channel and drop us a comment. We read every one and we always appreciate it. Where I want to start here is by just looking at the 1 week heat map. And what I want to point out are just that there's two notable pockets which are green here. We got Aapl and we got Tesla. So following up from last week where we were talking about the three white soldiers, today we're going to be talking about how there is actually an even more bullish pattern getting set up. What I'm talking about here is that, is this not three white soldiers, or is that like 10 of them back to back? We got 1, 2, 3, 4, 5, 6, 7, 8, 9. We got 9 back to back to back to back white soldiers. This one here is not really a white soldier, but anyways, while it gapped outside the range, every other bar is opened up within the range of the previous bar. So we technically have 8 back-to-back white soldiers. Isn't this incredible? The biggest company in the world just can't not go down. It can't not go up, sorry. As we have a look at the second company here, let's look at Tesla. So what do we got for Tesla? Basically the same thing, where once the squeeze starts, we just continue to go higher. And we're flagging out here on Friday, but what I would note on Tesla is that look at the closing price. It's 1010. It's just above 1,000. And when we look over here at Aapl, it's closing where? Just below 175. So what usually happens on any one of these stocks, and part of the reason why this is particularly bullish for me is because normally they like to pump them up into Wednesday, sell the calls, and then burn the calls into Friday. Because we're closing out 2 back-to-back high of the week closes, what that means is that they were not able at all to move these charts lower. All the calls got cashed up and printed on Friday. And that's most impressive because, again, Aapl and Tesla are the option stocks. So if we smooth this data out and we just look at Aapl on a weekly, what do we have? These are green dildos. Why? Well, there's basically no Wicks. We open at the low of the week last week, close at the high. Open at the low of the week this week, close at the high. Oh my goodness, that looks bullish. Let's look at Tesla now. Oh my goodness, it's almost the exact same thing, but a little bit off here on the highs. So what do we have for last week? Open at the low, a little bit of a push down, boom, close at the high. Then we gap up, we push down to fill the gap, we accelerate higher, and we close higher by double digits. So what this tells me is that there is still pressure building up. Why? We're closing at the high. And when we close at the high, what do? We usually go higher. So that's what I'm looking at here. And if the leaders are going to lead and then the followers are going to follow, that's what we want to look for this week. So hopefully you're paying attention, and that is a pretty good preview for what we're going to talk about today. Again, we're going to be looking at monthly charts, the wall of worry, closing on highs, and Tina. All right, now let's jump in and have a look at our PowerPoint for this weekend. So we're going to be talking about 50 weekly moving averages, the battle that we have for them, either above or below. And then we're also going to talk about monthly charts because we are closing out the month and the quarter on Thursday. So what I want to do right now is just show how these larger stocks are, again, they're the brightest pockets here by far in the last 5 days or the last 1 week of trading. If we now go back in time to year to date, we note that, oh, red. Okay, cool. So there's still red year to date. We see that energy has been absolutely crushing it, and everyone doubted the energy rally. Here we are. We're dramatically higher. We see that same thing happening right now where everyone's questioning what is happening with tech. If we look here to a shorter time frame, which is 1 month, okay, now we see value catching a bid. What? Like Warren Buffett, like healthcare, like consumer discretionaries and defensives like Costco, Walmart. We see energy still really strong. We see utility still really strong. We see insurance really strong. Chips are starting to show up here. Trillion-dollar companies are doing okay. Tesla is the notable winner. Now, if you look at the last 1 week, here is where we are starting to see that it's getting a little bit different. Why? Again, Berkshire Hathaway still doing well. Utilities hitting a fresh record. Energy doing well. chips starting to lead, Apple and Tesla pulling ahead. So what this tells me is that we're now we're maybe seeing some rotation, and the reason why is because I believe we are starting a new bull market. Everyone says that some of the most violent rallies happen during a bear market, and that's true. But when do they also happen? In a bull market, in a new bull market, like we talked about last weekend. And going back to our analogy regarding the 3 white soldiers, if we now look at Apple here, again, largest company in the world, what do we have? Well, we got 2 white soldiers. We get a third one, baby, that might be it. And all we need to go to new all-time highs. And what I want to look at here is actually going to be a quote from Mark Minervini. And what I want to point out here is just that all the big gains in a stock happen in new high ground. A stock cannot make a huge move without making new highs. In between, you are losing money or losing time. Hey, long-term investors, bottom fishing not only unnecessary, it's not where the big money is made long-term. I want to look at one other chart here just to frame the conversation here. This is NTR. It is a fertilizer company. We can note here that once it finally gets to new all-time highs, what does it do? It absolutely crushes it. And from roughly new all-time highs to where we are now, 45%, almost 50. Now we're going to look at a company like Deere. Again, they produce, right, let's go back in time here. Oh my goodness. When they broke through 175, which was the high back in 2020, what did they do? Absolutely crushed it, 150%. So when stocks do finally make that new all-time high, they do not stop. They keep chugging higher. And the reason why that's important is because as we have a look here at Apple, which is actually not that far off its all-time high, if we were to repeat this week or the last 2 weeks, again, 2 weeks ago, we went up by about 8%. This week, we went up by about 7%. If we repeat that again this week, oh my goodness. More than a 5% rally, and Apple is where? At new all-time highs. So what does that mean? Again, let's read this again one more time. All the big gains in a stock happen in new high ground. A stock cannot make a huge move without making new highs. What is Apple literally doing? It is building up pressure, pushing off the 50 MA with no real bodies. They were not able to burn the premium on these, and it's closing out at the high of the week. This is truly impressive. We look over here at Tesla, not that far off either. What did it do 2 weeks ago in terms of gains? Well, it went up by about low to high, went up by 15%. This week, it's only up by about 12, but pushed up as much as 15. If we repeat another 10%, oh man, we're all the way up here at about 1100. We push up roughly another 23%. Maybe we're going to be going higher. So that's what I'm looking for here. And even look at what Tesla did last time, right? Builds up pressure and releases. Why? Everyone's like, oh my God, Tesla's still so overvalued. Pressure builds up. 1 high of the week close, 2 high of the week closes, 3 high of the week closes, 4 high of the week closes, and then the drop, right? That's Elon saying, oh, I'm selling. So that's how a new high can get established. And I think what's really important here as well is that we're over the 50 MA. So what I wanted to talk about here is that the daily chart is going to feed through to the weekly chart. The weekly chart feeds through to the monthly chart. And because we're closing out monthly charts on Friday, what I'm specifically looking at is whether or not the daily chart is building up pressure, where the weekly 50 MA is, and then what is our best guess for where the new month is going to open up on Friday. Let's go through and have a look at Apple and Tesla as an example. Also look at Nvidia because these guys are the leaders. So before we look at Tesla or Apple, what I want to actually look at is going to be the sector they are in, which is going to be QQQ. So inside of QQQ, what do we have here? Well, we have that head and shoulders pattern, the same one we're seeing on SPY, and that gives us roughly 383, or the red number identified over here as that neckline. We are also still below this 50 MA. So what does this mean? We're building up pressure to the 50 MA. We're not even over it yet. So we have to build up pressure. We have to release it by getting over, and then we got to test this 50 MA, this head and shoulders neckline. So what I would note here is that QQQ is actually below the 50. It is trying to build up pressure to it. If we have a look now over here, it's Apple. What is it doing? Well, it back tested. So it's been over the 50 MA for pretty much since 2020. One week below, right back above. Bounce, 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 bounce. Every time it touches the 50 MA, it bounces. And the reason why that's important is because Apple is showing us that it's clearly a leader pushing off the 50. If this thing's going to go up to new all-time highs, sorry, go back to the all-time high, it's likely going to drag QQQ up to where it is. We can now look at Tesla, where it is now over the 50 MA and making progress towards, again, roughly 1100. So it's at 1,000 right now. 1100 would be the next catalyst. So what this tells me is that these stocks are still the leaders. And after a period where they test the 50 MA, what do? They don't stall out and go sideways. What do? Boom. What do we do here? Boom. Nike swoosh. Just do it, baby. So why would this time be different? Nike swoosh. Oh my goodness, really? Yeah, well, everyone's like, oh, Tesla's already worth $1 trillion. It can't go higher. Of course it can go higher. Things can do what you don't expect. That's why the saying of the market can remain irrational longer than you can remain solvent is so widely understood. All right. Next one to look at here is going to be Nvidia. So what Nvidia is doing is actually also bull breaking. Doing what? Pushing off the 50. And every previous time that Nvidia has actually tested the 50, what did it do? Swoosh, swoosh. Are we setting up a swoosh here? No, we don't need chips anymore, Justin. There's no chip shortage. We don't need chips. That's a thing of the past. It's like so 2020 and 2021. I don't believe so. And now if we have a look at some of these major ETFs, again, what I want to point out is just that QQQ, which is the number one thing that I'm tracking, is not over the 50 yet. And if that's so important, this is pretty much going to be my telltale sign as to whether or not S&P is actually going to pass. So if we have a look here, QQQ is closing out the week up by roughly 2.2%. S&P is closing up by about 1.84. So QQQ is still outpacing SPY. And when we look here, we are almost at the 454 neckline for this head and shoulders. Again, that's these red lines right here. So what that tells me is that for SPY to advance over this red line at 45405, what are we going to need to see? Well, we're probably going to have to see technology drag us higher. Why? If QQQ rejects on the 50 weekly moving average, S&P is likely not going to clear 454, 455. That's my biggest clue here. So if we actually get to here and push over, that's bullish. It's likely going to lead to QQQ wanting to snap up to its 50 weekly, its weekly head and shoulders. And by contrast, that would actually drag S&P up over, probably up to 460, if not higher. And that is where we get a decisive break. And the reason why this is so important to me is because when we close at the high of the week, what it means is that there's pressure building up. And as we've noted for the last 2 weeks, when we close at the high of the week, we usually see immediate follow through the next week. Why? Closing at the high of the session, whether that's a daily, weekly, or monthly, means there's still pressure building up that's not been released yet. The pressure gets released when we start to go sideways before maybe going back down. So now let's have a look at this with a critical eye. And let's also look at one more thing here, which is going to be our key dates for this week. So there's nothing really major happening here, but on Friday, there's going to be a big push of 3 big data points. We got payroll Friday. We got a new month and quarter opening up. And then we also have a EU and China summit. So keeping those in mind and remembering that we still have pressure building up, which means it should get released into the early part of the week, which means we should be testing this key area into the first half of the week before Wednesday. And if we look at QQQ now, again, what do we have here? Well, we have the same thing where if we can't rally an additional 1% after putting in 2 last week, that's probably it. We're not going to go any higher. It's going to be a double top. So also keeping in mind that if they want to make money on Apple and Tesla calls because they're not going to pay out, what should they try to do? Pump them up into Wednesday, sell the calls, burn the calls into Friday. So there's every reason for me to think that the push into the first half of the week should continue. And where we go from there, I'm not 100% sure. However, now let's have a look at some of these monthly charts, because what's more important for me than the weekly chart is actually going to be the monthly. So when we look at our lines here, which are drawn, what do I note? The first thing here on SPY, we have 1, 2, 3, 4 months of dip buying, which means going all the way back to December, the bulls were ready, willing, and able to buy. They bought in December. They bought in January. They bought in February. They bought in March. So they've been buying for 4 months with almost no upper wicks and lower wicks. What I would also note here is that the weekly charts for SPY, QQQ, Aapl, Nvidia all have 2 white soldiers. We get a third one, and that's likely going to feed through to follow through on the monthly chart where we're going to what? Go higher. So right now, what we don't have is a trend change on the monthly chart. We got a high, higher high, bearish engulfing. Here we got a lower low and a lower high. Here we have a higher low, but a lower high. So what do we have? We have a full inside bar here for this new month. If we close out the month and push green, what's that going to mean? We're going to have a higher high, we'll have a higher high. And if we don't push down, that will also be a higher low on the chart. Looking at QQQ, and actually one more thing I want to point out here, this neckline for the, again, this is a massive head and shoulders. So first thing we have to do is actually break the weekly head and shoulders, which is at 454. But then over here on the, let me pause for a second here. So again, the weekly head and shoulders neckline is at roughly 454, or the high we put in on August 30th here. So that high is the first test before we open up the new month on Friday. And our monthly head and shoulders here, in my opinion, is found at 458, 459. So by clearing 460 and by getting back above the January high at 458.18, what does that mean? It means we got a bull break. We now have a new pattern here. We don't have lower lows and lower highs. What are we going to have? High, low, higher low, higher low, higher high. Oh my goodness. So if we can push up roughly 2% more on S&P, we've got a monthly bull break. Looking over here at QQQ, we have something very similar setting up. Here we have one, right? We got 1, 2, 3, 4 months of dip buying. We see that buy the lower wicks. There's almost no upper wicks, which means no one's been trying to advance the chart. They've been trying to buy the dip. So if they bought it in December, bought it in January, bought it in February, bought it in March, what does that tell you? It tells you the bulls want to buy. They've been buying the whole time. Through all the fear, all the worry, they've been buying. They've been climbing the wall of worry. And these monthly charts look good. They're closing at the high. And why? There is no alternative. All right, let's move forward and have a look here. So again, low, lower, low. Do I have a double bottom here? 318. Here we got 317. So low, lower, lowest. Low, lower, lowest. Interesting. So QQQ is actually lagging, and that is why only select names on the heat map here are actually pulling forward. Why? Because not everyone's a leader. The leaders lead, followers follow. All right, cool. So now what this also tells me is that when we look here at our monthly chart, again, the key area for me on QQQ monthly is going to be roughly 368. So we need about what? Another 10 points, or also about 3% on QQQ. So if tech is still leading, 3% on QQQ versus 2% on SPY should be no problem. And with this pressure building up, and the first month after 4 months of dip buying, where we're set to close at the high, fingers crossed, that we should be getting some pressure get released. Why? Look what happened here. Close at the high, dump it down. Here we close at the low, we open up flat, push it down more, come back up, right? So we come back up, sell off, open up, sell off, come back up. This is the first month where we have a hammer, but it is also closing at the high, which means we got monthly pressure building up. And for 4 months, as high as basically 400 on QQQ, they were willing to buy. So what this tells me is that, like I've mentioned before, if we have a look at our key dates here, if we can get through these first part of the week and we close out the quarter, then we could be set for a big push into April, which is what I was already looking for. Last thing I want to point out here is going to be our quarterly chart for S&P. And we talked about this for the last couple of weekends, so I encourage you to watch that again if you want to. But there's one next thing I'm going to look at here as we go forward. This quarterly chart for me is bullish AF. It is so bull. If we're only going to have a 1 quarter sell-off or one candle, we should decline and then advance, decline and then advance. By the way, each candle here is worth 3 months, which means that's a 1-year expansion. Here we go. 1, 2, 3, 4, 5, 6, 7. That's almost 2 years of expansion. So what's really important here, and we're going to get to this a little bit later, is that everyone's saying, oh, but the yield curve is going to invert. The saying is that every recession is preceded by a yield curve inversion, but not every yield curve inversion is followed by a recession. What does that mean? A yield curve inversion is not a guarantee. It means most of the time we do, but it's also a lagging indicator. The recession can come 1, 2, 3 years after we actually see the inversion. As of right now, there's no inversion. The 2s are at 2.25. The 10s are at 2.5. So what does that mean? We've not even gotten our signal yet. And like in 2007, 2008, it took over a year for that yield curve inversion to actually signal a recession. So I think the bears are getting a little bit ahead of themselves, saying that, oh my God, the big one's here. We have to go down. So this is going to be it. We're going to have our one sell-off, and then we expand for minimum a year. Cool. If we don't, meaning if we open up the next month red, that means that we're going to be doing a double top, right? Somewhere between roughly where we are now and 458. We're not going to go higher. We're going to stall out, and we're going to sell off. I would also note here one more thing as we look. I mentioned this before, but since it's going to be on Friday, look what we did here. So we closed the month out. This is the end of the year, so it's not the greatest predictor because we're not going into the next session, but we close at 24992. Here we open at 246, which means roughly a 1% gap down. And then what? There's no lower wick. We just pump up. Looking here as well, what do we have? We close at 257.75. Here we open at 247, almost 10 points lower. Again, that's 2020. So let's keep in mind here that that was a historic time, but we gapped down a couple percent. So that same thing could happen here. And we have the dates to line it up. We've got the quarterly rebalancing and options expiry on Thursday with initial jobless claims. And then the next session, we're going to have payroll Friday, the new month and quarter opening up, and also an EU leader summit, which could drive us massively into the next push. All right, so a little bit different than what we talked about before. We're going to go back to our schedule now. So 50 weekly moving averages pushing through to monthly charts and then the quarterly charts. So now let's have a look at our base case. And by the way, the only thing that has changed here is number one, I added in a sub bullet, which is right here, inflation environment, which we touched on last week. Again, number one, there is no alternative. If you look at the charts and you ask yourself, is the chart telling me something I might not see? Stop trying to tell the market what it's doing. Stop trying to tell Mr. Market, oh, you're bearish. Oh, you're bullish. Look at the chart. It's telling you something. And if it's closing at the high of the day, high of the week, high of the month, there's clearly no alternative. And the reason why is because what are you going to do? Hold on to cash and lose 7-8% a year? You're going to buy a bond and only lose 5%? What are you going to do? The only place to go, the only game in town, which is liquid. Again, if you buy a house, you buy it today, you want to sell it tomorrow, you got to pay for fees, you got to find a buyer, got to find a seller. It's a big endeavor. Buying and selling a stock, you can get in and out literally the same day. It's super liquid. It's the most liquid area. Also, companies that have pricing power are going to do that. We're going to touch on that in a bull case a little bit later, but there is no alternative. The test up to 454.0205, basically that head and shoulders neckline. We got within 0.25% or a 0.25% of that area. So I actually think we're going to hit that 454 now, not just up to, but we're actually going to hit it. And from there, what are we going to get? Bulls and bears will fight for direction. Bulls still have the edge. As I noted, daily, weekly, monthly, high the session closes are super bullish, something we've not seen going back to 2021. We're also going to have that OPEX and quarterly chop, which again, I still expect. And then I expect we're going to see relief into April, and the quarterly chart is going to get us there. I'm going to show one more thing here to try to keep the story going. That's going to be here. So there is a lot of noise on the options chains lately, and there is massive flows flowing on SPX. But what I want to show here is going to be a straddle. This is what I'm noticing for the next month. And people look like they are positioning. It's not a huge amount. Usually I like to see 100,000 in open interest here. Here I see 49,000 at 450 in OI on the calls, 32,000 OI on the puts. But when I look at the volume, it looks like they're building it up here. So we got about 22K on the puts, 17K on the calls. And if we take these two numbers together, add them, meaning how much premium do they need to make to get their money back or break even, we got about 8.8 plus about 6.25. So that gives us, 6.25. So what does that give us? It gives us $15. So if we take 450 minus 15 points, they're break even for them to get their money back, not make anything. They get their money back at 435 on S&P, or we take 450 and add on 15 points. That's 465. So what that tells me is that by the expiry in April, which is the 14th, we're either going to be 15 points higher or 15 points lower. Now let's have a look at those charts again one more time to make sure we understand. And if you do, again, please smash a thumbs up, drop me a comment. I would really, really appreciate it. So looking here back at our monthly chart, we're going to focus on the S&P because, again, this is just what I personally care more about. So what this tells me here is that adding in our lines, it means that we're either going to be back down here closer to the green line at roughly 428 or our quarterly base. And again, 435 is break even. They think they're not betting this kind of money if they just want their money back. They want to get paid. And because they're buying a straddle and not a call spread or a put spread, a straddle just means we think we're going to push one way dramatically, either down, up or down. A call spread thinks I think we're going in this direction, bearish or bullish, and I think we're not going to get any higher than a certain area. So when we see big money flowing in with call spreads, it means they're bullish. We see big money flowing in with put spreads, it means they're bearish. If we see straddles, they don't know which way we're going to go. They're just expecting a massive move. So looking back here, if this is going to be a fail, I've already laid out the levels, and now we have the motivation for here. Why 15 points is a pretty big move in roughly 3 weeks here, right? 2-3 weeks. That's a massive move. So we're either going to be all the way back above here at 465, breaking bullish massively, or we're going to be breaking down, falling back below this trend line. That's pretty much it. This is the story in a nutshell. Now we're going to go through and tell the rest of the story here. So let me make sure I'm on track here. That's my base case. In terms of key dates and events, the biggest events are going to be coming in on Tuesday, Thursday, but they're also not bolded or underlined, which means they are notable, but they're not the most important. Most important before Friday is going to be the quarterly rebalancing and options expiry. So what quarterly rebalancing and options expiry means is that if you are a money manager, you can't just go and sell your stock every day. You need to be insured. Like if you own a house, you're like, oh my God, there's going to be a fire. You don't sell your house, you buy insurance. And on the same token, if you want to, say, sell a large portion of one stock to buy another, it's very hard to do that in the open market if you are buying and selling millions, if not billions of dollars worth of stock, which means they usually have a predetermined date where they're going to do a rebalance. And if there's things that are now higher, meaning they're a higher weighting in the portfolio, you have to trim them back down to get down to that desired percentage they want. So on the 31st, we're going to see some companies have a big move higher and some companies have a big move lower. And we're going to see a lot of volume transact into the close on the 31st, which is when that quarterly rebalancing happens. So if companies want to, say, buy Aapl, they're going to want to what? Hold it down. So that when they are assigned on Thursday close, they're going to get a lower price and it's going to go back up higher on Friday. If they're trying to sell, they want it up. So they're able to dump it at a high price before it goes lower. So there's going to be extra motivation for manipulation in terms of just the rebalancing, but then also for the options expiry. We also have that 45.10, 45.20 put spread expiring on SPX on the quarterly expiry. I'm not going to go through and review that right now. Just it's a no. On Friday, the biggest events for the week all happen on Friday. The one that I think it surprises the most is going to be the one with the EU-China summit. I want to look at that really briefly here, and then we're going to push forward. So just looking at this, look at the date it was scheduled. It was last updated more than 25 days ago. This is basically before we saw what's happening in Europe transpire. So what this tells me is that EU plans summit with China on April 1 to address tensions. There were tensions even before what happened in Ukraine. So now all of this is going to bubble up to the surface and we're going to understand whether or not China really wants to be on the right side of history. And with President Xi going in for a third term and a life term, as being the leader of China, he needs to look strong and he has to make deals because China sells goods and they need people to buy. If Europe's not buying, if America's not buying, who are they going to sell to? The industrialized world is the one who has the money. So if they lose Europe, if they lose America, it's nice you guys can make cheap stuff, but who are you going to sell it to? I don't know. So we know we are in a complicated phase of relations with China, is what they mentioned here. They're also talking about it's going to be between the two, right? So it's let's just get forward to here. They're referring to an investment agreement struck in China that is stalled after Beijing imposed sanctions on some members of parliament, right? Blah, blah, blah. It is clear that some of those topics need to be addressed at the highest political level to see what extent we align and improve our cooperation. The summit is likely to be virtual rather than in person. The EU regards China as a strategic rival in some fields, but a partner in such as fighting climate change. It also wants to bring China on board in its push to reform, blah, blah, blah. Did not say whether Russia invasion of Ukraine would be part of the summit, but again, we all know that's a big issue right now. So all I would mention here is that I don't know what they're going to say, but I expect the posturing is going to be a very, very important clue for us. What we noted is that the dual listing, before we had the Xi and Biden summit, 2 days before, what did we have? We had the the relaxing from the Chinese government on dual listing stocks like Alibaba. They also injected some money into the system, and they were actually basically accommodative. So if we're going to see anything like that from China before their meeting with Europe, I would expect to see it soon. And we know the stakes are very high right now. So in terms of this event, it's definitely up there for me. And that's what I think could be the biggest driver for us. I don't know why it's skipping forward here. Let's go forward. All right, moving forward to here, the agenda. So I mentioned in depth about the bear trap. I don't think these bears understand what a high to session close is. I would also note that how do we invest in an inflationary environment? We talked about Warren Buffett on this last weekend, and that means that stocks, again, Warren Buffett's like 94. He's traded through way more cycles than I have. He's also smarter than I am. So why reinvent the wheel when there's been inflationary environments before, there's been stock market crashes and stock market rallies? Let's defer to him. What he said is that stocks are your best inflation hedge. And we're going to talk about that in a moment here. I'm going to show one thing. Oops, I think I stopped the PowerPoint by accident instead of just going to the next slide. Here we go. So let's go like this. And now let's drag that over. Here we go. What I want to show here is that, oh, there's my face again. Let's go back to here. What I want to show is actually that here's Microsoft. And the reason why I want to talk about Microsoft is because this is announced in August of 2021. New pricing for Microsoft 365. Today, we are announcing changes to our commercial pricing for Microsoft 365, the first substantial pricing update since we launched our service a decade ago. What are they telling you? We've not raised prices for 10 years, but now we are. Who else is raising prices? Netflix, right? Who else is raising prices? Everyone. Why? Because they can. There's no alternative. Are you going to stop using Microsoft 0365 because it costs $2 more a month now? I'm not. I paid the fee and I enjoy it. I'm happy with it. So the reason why I think this matters is because when you think about all the companies that you use, are they American? Again, think of me. I'm recording right now. I'm on an Apple computer. I got a virtual machine here with Microsoft. I'm using Google Chrome. I'm also using Slack, which is an American company. What else am I using, right? Everything I'm on is American, everything. So when it comes to pricing power, in terms of the next stage of the cycle, I don't know any stronger company than Americans. Are you going to stop watching Netflix because it's $1 more per month? Are you going to stop using any of these services? No. That is called productivity growth. And in an environment where people are very worried about exporting raw commodities like wheat or like fertilizers or like any metals, right? Anything. They're really scared of selling those physical goods. What does America produce more of than those? They produce intellectual goods, software goods, digital goods, which means for them to go find new buyers or to disperse out their costs is not that high. We talked about this in depth last weekend too. I just want to reiterate it here where a SaaS or a software as a service is going to be some of the strongest companies because for them to go increase their price, they don't have to spend a lot more money. Microsoft is likely not going to see a substantial increase in costs when they bump up that monthly fee, which means they just make more money. And again, a PE ratio is based on two things, price and earnings. So if an inflationary environment is telling us that Microsoft is going to charge a higher fee, it means they're going to have more earnings and their PE is actually going to compress. So I mentioned this inside our Slack group a little bit earlier this week as well. And I'm going to say here that Apple is the leader of technology along with Tesla and Nvidia. However, when we look here at QQQ, we note that its head and shoulders neckline or this left shoulder here is from August. It's also at 383, which means as of right now, we got a rally up by about like 10% on QQQ. Sorry, 7% for us to get back up there. However, now if we look at Microsoft, what do we note? Oh my goodness. It is right on that neckline. So what do we have? Shoulder, head, shoulder. It's right on it, which means that Microsoft today is as bullish as it was back in August. It's also pushing off the 50 MA. So what this tells me is that Microsoft is clearly a leader. Why? It has pricing power. It is a must-have service, and it's also turning more into a SaaS. So what this tells me as well is that Microsoft's also ready to go. And all the companies that are essential to the next phase of this economy are going to be very important. So what I'm trying to show here is that even though we are seeing some weakness in names like the Russell and the Dow, ask yourself this. 2,000 small companies, do they compete on quality or do they compete on price? There's 2,000 of them, by the way. How many Microsofts are there? One. How many Apples are there? One. How many Teslas are there? One. They're not competing against anyone. They're in their own sandbox. However, if you sell something like a widget, pretend you sell, I don't know, you sell widgets, right? So you sell a widget. If you are charging $1 and your competitor charges 95 cents, what are you likely going to have to do? Lower your price to compete with your competitor. Microsoft doesn't have any competition. Apple has no competition. Tesla has no competition. They want to raise prices? They can. That's the really big difference here. So when we're looking at charts like the Russell or other ones like the Dow, whatever, I think it could be a little bit misleading because people don't understand what pricing power is. And that's really important. All right, moving forward. Monetizing debt. So we talked about this before too. I'm not going to go through it. I think Jerome Powell is monetizing the debt. Why? Well, because people can't afford their bills. They can't afford it. And they're not going to let these companies just fade away. It's also now becoming a national security to make sure that our companies are strong, well capitalized, and the leaders of the world. The wall of worry for the fundamentals is just the geopolitical tension and the hawkish rhetoric from the Fed. We keep climbing the wall of worry. And again, too high the week closes after the FOMC and after we heard basically every Fed head talk this week. So we're either getting a disconnect between the bond market and the stock market, where the bond market is saying the Fed's got to move faster, and the stock market's like, yeah, not quite ready yet. One of the markets is wrong. I don't know which one. Is it the bond market? Is it the stock market? I'm not sure. And what I'm hearing everyone talk about fundamentally is that the Fed's going to have to battle with an inevitable battle between recession and inflation. I think, again, I hope that they can get this both under control. And as of right now, we don't really have a major data point coming until the 11th, which is going to be CPI. And we don't have the Fed meeting minutes coming out until the 11th. I'm not sure if I showed that. Let me just show that really fast here. So looking back at our key dates here, just looking to below. So as we're going to be opening up this new month, we got CPI coming out on Tuesday, the 11th, and then we got the Fed meeting minutes coming out on the 15th. And just the reason why this is important is because the last two times the market got a surprise was when we got a very high CPI number and when the Fed meeting minutes from December in January showed that actually we're ready to move faster than expected. So after this April 1st date here, there's no major event happening until the 11th. So that tells me that if we're going to keep climbing the wall of worry, the next major hurdle is going to be almost 2 weeks out, 3 weeks out from today. The market can keep going higher and prove these bears wrongs until then. All right, there we go. Geopolitical tension. Again, how can it get worse? I don't know. Federal Reserve speakers, they were all basically barking the same thing. And now we've got basically 200 basis points being baked in. And we're going to have at least 150 basis point meeting to get to that 200 basis point by the end of the year. Why? There's only so many meetings. Yield curve inversion, again, hasn't actually happened yet. And when it does happen, it's not an immediate follow through. Like the death cross, it's a lagging indicator. So if yield curve inversion has not happened yet, and it can sometimes take years before it actually self-fulfills, what are we so worried about? Let it actually invert. And when it actually inverts, if we print a monthly lower low and a lower high, boom, there's your drop. Tina, there's no alternative. There's not. And the China put, we already talked about that, right? He's going into an unprecedented third term or a life term for being the leader. He wants to look good. He wants his people happy. Well, how do they feel happy? When they feel rich. Interesting. So we also talked about the technicals here where we have that April 450 straddle. So roughly 2-3 weeks from now going into this. Why? It's going to be, I believe, on the 15th when we have this next expiry. So $15 in premium. That's a lot. We're climbing the wall of worry from the technicals as well. Let's briefly touch on that. So over here, everyone's like, oh my goodness, we're back below 200 DMA. That must be it. No, it was a one drop and then we went higher. So what did we do? Let's actually go here where it's a little bit easier for us to look at this and I can draw. So let's go here. Let's just delete everything and I'll just undo when I'm done. So what do we do, right? We slingshot up. We test the 50, back test the 50, get over the 200, back test the 200 and advance. We cleared the 50 and 200-day moving average. That is super bullish. That's basically the stock climbing the wall of worry. So as it's climbing the wall of worry from a technical perspective, it looks really good. Let's look at a template now to see what that can actually do. Let's look at Aapl. So Aapl, right? boom, over the 200, back test it, boom, up to the 50, boom, hasn't looked back. It's climbing the wall of worry. Look at Tesla, right? Boom, over the 200, boom, over the 50, boom, flagging out. Bullish, looks great. So what that tells me is that the technicals are also climbing the wall of worry. 50 daily moving average, 200 daily moving average, and then the 50 weekly, which we've already talked about. Now we can look at the heat map and the fear and greed index. So let's think about this. People are a little bit less scared. And when do people like to buy? They like to buy high. So if we're not quite at all-time highs yet, but we're seeing some very strong weekly gains, and we're now into neutral zone, what does that mean? People are ready to buy. They're not feeling as scared anymore. And the market can go higher when there's been greed. Let's also look and see whether or not there's actually been any greed in the system for the last year. Nope. Year ago, fear. A month ago, extreme fear. Then we went from extreme fear back into fear and now into neutral. If we get resolution in Europe and we don't see that the recession is imminent, maybe it's 2023, maybe it's 2024, whatever. What's going to happen? Boom. Bear trap. Now looking at the heat map. We've already talked about this. Like I said, I'm noticing that the year to date where technology all stinks, select financials, meaning value is doing good, right? ATVI up 20, right? Healthcare doing okay, energy doing good. I'm starting to see that shift here. But look at the last 1 month. Again, it's mostly been the value trade, right? Healthcare, consumer defensives, right? Industrials, energy, utilities, select tech, but not ubiquitous, not all of them. Some semiconductors, but not all. On the last 1 week, it's looking a lot better. Where we're seeing the pockets of green is the rotation into Aapl, into Tesla. And after these guys drag us higher, we're likely going to see follow through buying into the other ones. Also noticing that home improvements down, right? Over here for restaurants, also down. Some healthcare down. Financials flat. Energy still doing good. So I'm noticing that we're seeing that rotation happen underway. And it is also extremely unusual for Aapl and Tesla to have nonstop green for 2 weeks in a row when they got to juice up those calls and then pay them out. It's a lot of money they got to pay out. So that's it. All right, 3 white soldiers on Aapl, Tesla versus QQQ and SPY. We've already talked about that too. So I'll just reiterate that one more time here where we have Aapl over here and Tesla, right? So nonstop green, right? Nike swoosh, just do it, baby. Aapl is the most evident one. And if the bears were hoping for a drop, it just didn't happen. Higher high, higher low, higher high, higher low. Oh my God, it's going to be the 50. That's where we're going to stall out. Nope. Higher high, higher low, higher high, higher low, right? Straight line up. This is about $500 billion in market cap being created, by the way. A $3 trillion company going up by roughly 15%. That's about $500 billion created. People like when they get money in their account, and they like when Aapl goes higher. So now let's have a look one more time at these charts on the weekly perspective. What do we have? Well, we got the first 2 bars. Really? Just 2? Yeah, just 2, which means they're likely going to feed through tomorrow. Look over here, right? 1, 2, 3, 4. That's a whole month of rallying. Oh, that's right. Let's look over here at QQQ. Again, technically a white soldier because it opened up within the range of the previous range and closed at the high. Cool. Nice. And then finally, again, as we look over here to our quarterly chart, what do we have here? We also have the exact same thing. White soldier, that's not quite at a high. So, right? White soldier, white soldier, white soldier, indecision. Boom. Yeah. Isn't that bullish? Even here, right? Close near the high, near the high, near the high. Boom. So a weekly chart is going to be having a very bullish setup before the monthly and before the quarterly. But if we're right and we're going to continue to go higher, and everything says we will, all we got to do is actually self-fulfill. And the reason why this is most important to me is because if you're bearish, you're only going to realize this pattern is setting up what? After months or maybe even after quarters, which means you're going to continue to be wrong for potentially months, if not quarters. Please don't. Know where you're wrong, know where your pain threshold is, and if it prints that area, get out. That's called a stop loss. It stops you from losing more. It stops you from going bust. It helps you survive the trade another day. All right, ETFs, Trillion Co, SPY, and options. I want to show one more thing before I forget this too. Looking at monthly charts, I want to do all of these right now. So again, we talked about S&P and QQQ all having these massive lower wicks. So what do we have here? This is QQQ. 1, 2, 3, 4 months of dip buying. Cool. SPY, what do we have? 1, 2, 3, 4 months of dip buying. Cool. Let's look at BTC. What do we got? 1, 2, 3, 4 months of dip buying at the high of the month. ETH USD. What do we got here? Oh my goodness. 1, 2, 3, 4 months of dip buying near the high. And looking back to here, like we did on ETH before, let's delete everything. So we got 1, 2, 3 lower wicks and booms. That's a rally of, I believe, 100% from the low. So from the low, yeah, 183%. What do we got here from our low? We got up 183%. Baby, we're going a lot higher, right? 6, 7, 8,000. Let's go. This means there's pressure building up, as I noted before. So all of these show it. Let's look at XLF. Oh, indecision, dip buying. Yeah. Let's look at XLV. Dip buying, release. Cool. There's the higher high and the higher low. Aapl, what do we have here? Again, we looked at the shorter time frame. Oh my goodness, it looks almost exactly the same. 1, 2, 3, 4 months of dip buying. Cool. Tesla, 1, 2, 3, 4, 5 months of dip buying. Oh my goodness. Every major risk asset that I care about is showing me the same signal. Months of dip buying. I'm talking 3, 4 months of dip buying. These bulls were willing to buy. They're willing to hold through potentially WW, right? You know what letter. Willing to hold through the Fed going from team transitory back in December and January to, oh yeah, by the way, we got to hike like 200 basis points, which is where we were supposed to be by the end of 2024. That's where we're going to 2023, 2024. That's where we're planning to be in about 6 months now, 6, 9 months. They're not deterred. And as Mason actually mentioned before too, I think individual names have already had the, right, the 2000 drop. Look at this, right? Look at Zoom. It's now from peak to trough down by about 84%. Oh my goodness. Look at DocuSign. Oof. All right. Yuck. Down by 77%. Let's look at ARC really fast. Peak to trough. Oof. Right. 2/3 haircut. Right back to the previous tops. Also, though, what do we got? 1, 2, 3 more, 3, 4 months of dip buying. And we also saw $1 billion in inflows to ARC. So people are ready to buy risk assets. They're not deterred. So if they're willing to buy ARC, are people not willing to buy Apple above that, or Tesla, or Nvidia, or Microsoft, or Google? Any of those? I think the answer is yes. If they're willing to plow $1 billion into ARC, which is down by 2/3, wouldn't they be willing to buy something a little bit more safe, like a big blue chip, $1 trillion company? Yes. Smash a thumbs up if you agree. All right, ETFs, we'll look at those in a second here. Then the $1 trillion companies, again, they're all flashing major bull signals. Then we'll talk about SPY and options. This is going to be a longer video. Didn't intend for it. Let's just go forward here. So the bull thesis, again, is it almost over? Here we are. This looks like it's almost over. We talked about this for about a month now. I think I'm right. Is it a guarantee? Of course not. But I'm seeing more evidence that tells me that up versus down. Why bull or bear? Well, monthly bottom is in. We're at closing it. We're set to close at the high of the month. Peak hawk in geopolitics. I think so. What else? I literally do not know. I've been trying to find that extra reason for the last couple of months now. And right, bears. Wheels are in motion. They still are. Peak cycle. Well, again, we talked about that. I believe that the TINA, we'll look at that in a moment here, is been deflected. There is no alternative. Inflation narrative. Yeah, inflation's real. We'll see what happens when we get the next CPI print. Surprises, EU and China summit, and then geopolitics. Again, I'm talking about right, Ukraine. Moving forward. Debt monetization. So I just want to repeat myself here. I know this might be getting a little bit right, overdone for some people, but the reason why I think this matters is because we have to remember that before the right before the sickness came, people only had about $1,000. They couldn't even afford $1,000 in emergency expenses. Now, if people are buying into a housing market which is quite elevated, if we have that housing collapse, it's 2008 all over again. So Jerome is monetizing all this debt. We printed all this money. Now let's make it worth nothing. And I think it's also very important to note that they were even buying mortgage-backed securities as late as the beginning of this month, not because they wanted to, because they had to. So the average person is going to feel a lot more of a pinch if their house price goes down than if it doesn't. So there's a very fine balance between inflation and a recession. And if I'm reading between the lines, I think Jerome would rather have higher inflation for longer because the US can ultimately produce their way out of it with productivity gains. Again, or software companies versus the rest of the world, because we're all having the same issue right now. then saying, I'm going to bring on the recession. Oh, and by the way, we also have inflation. Inflation's going to be there. The recession is a maybe. It's not a guarantee. So I think Jerome is actually doing a third mandate. Everyone talks about price stability, job stability. I think market stability, housing market, stock market, bond market, all of them. Tina, we've been seeing this, and I hope you are too. There is no alternative to the US dollar system. There is no alternative to the US stock market. There is no alternative to the US pricing power. There is no alternative to the US military. And there is no alternative to the US politics. Is it a perfect system? No, but that's what a democracy is. There's people on both sides who are arguing and debating, and when the people get elected, they make the calls. So that's what's important here. The US is still the superpower in terms of every area that matters for me. The bear case. All right. Look at these nice bears, right? What did they get? Well, it's the same thing as before. So, right. Why bull or bear? Well, we have every reason to go down and we're not. So it's the same thing we did before in March of 2020, in November of 2020. Oh my God, Joe Biden's going to kill the stock market. Nope. We went higher. Biggest US presidential gain after he got elected ever. Boom. And people were like, oh, but he's going to be the president of tax. He's going to tax us to death. He's going to redistribute the wealth. Stock market did not care. Didn't care in November. Didn't care in March. Why should it care now? This right here, again, we've been hearing about balance sheet runoff. So that May meeting is when? It's in May. So we got April and then May to get through. If they're going to announce a balance sheet runoff that's faster, we're going to see that previewed in the meeting minutes on the 15th. And then we got another month until they actually announce they're going to be reducing it. So we got tons of time before this happens. Bear market targets, yes. I think eventually some more of these areas will get filled, but these are only when we're trending down. And what we've been doing on the daily, weekly, and monthly is breaking the downtrend or stopping to go down, starting to go flat, and now starting to go up. Why? Higher highs and higher lows. I also want to briefly touch on this one right here, which we also have from before, where this was my big bear thesis. And we were sitting at 4,400 at the time when I showed this. This is like back in January, I believe. Oh, man, I did it again here. Let's start that PowerPoint back up. Where am I? This one here. So I'm now going to go to look at this chart, which is SPX. And I have this one here on a monthly chart. And what I want to show here is just that what I was trying to show here is that I thought we were going to get a lost decade. And could I still be right about this? I don't know. But what I think is... if we go to a log scale, what I thought was going to happen is that we would come back and back test basically these previous tops, kind of like we did back here in January, where we go down by 50%. A 50% decline from our current highs takes us down to where? Right. We get down to roughly 2,000. Why? Well, again, roughly, right, 4,800, I believe it was. So 4,800 divided by 2, right? We got about 2,400. What would that be? It would be a higher low versus the low we put in January. The other thing I would note is that when we look back to this period here, which is 2000 and 2008, what I would note if we hide everything on here is that it's not as clean of a pattern. So even in here, what do we have? Well, we have some dip buying, but it's not like continuous. We get a big pump, right? We get a dump, buy back up, and we get roughly a double top here. Over here, higher high, and then the dump. And when we dead cat bounce, it's off the average. So when we look back over to where we are now, we have to come all the way back down to here to confirm it. So you're going to know we're bearish when we're down 1,000 points. Also, when we slap this in here, what's very obvious to me is that we could, again, we're talking about a quarterly chart. So on the monthly here, if we're going to break bullish, not stalling out here does not mean we've averted the potential drop. It just means that maybe we're going to go all the way up to here, actually print 5,000, and then go down. But what I would note is that at no other time in 2000 or 2008, was the head and shoulders pattern as clean as it is here. So we can note that again, there's clearly a head, there's clearly a shoulder. And if we can blow through it, it doesn't mean that that is going to be the guarantee we're going to go higher. It just means that the pattern is not quite complete. Let's go back in time one more time here to 2008 to 2020. And let's just look and see if we can identify it here. So we delete everything, right? There's not really a head and shoulders pattern here. It's just a cup and handle that fails. Here we got higher highs as it's forming here as well, right? It's not really a head and shoulders pattern. High, highest high, sloppy right shoulder. It actually punches above the left shoulder here. So I don't know. I don't know for sure, to be honest. We could be like right here where, again, we got our head and shoulders. And then on this month right here, we actually go back up. That's the fake out. That's the bull trap. I don't know. The reason why I'm so convinced for right now, again, got to be like water where we're fluid and able to adapt with the market as it changes. But the reason why I'm having a really hard time, and I was the big bear. I was betting big bear too. The reason I'm having a really hard time trusting this pattern here, looking back to 2000 and 2008, is because of the potential for a black swan event. We've now seen that. We had a major military engagement here. And we also had a major test of the US dollar reserve currency status, the SWIFT payment system and everything. And there is no alternative. So for me, because we're seeing peak hawkishness, peak geopolitics, reserve currency and current superpower being challenged all within a couple months, and US is still supreme, I don't know what is going to drag us down for a major next leg. Also, as we noted from before, let me see if I can actually pull this up. I don't know that I can find it, but it was, again, from Mike Minervini, the market wizard, also talking about how the stock market usually starts to rise in the beginning of the rate cycle and usually breaks after 9 to 14 rate hikes. So as of right now, we are expecting 200 basis points in hikes, which is the equivalent of 8. If they do it that fast, they could break the system when they get to roughly 9 to 14, which would be when? 2023, where we get to that 9 threshold. 14 would be probably be in mid 2023. So I believe that there's still room for the US to raise rates and for the US market to go higher. The Fed usually breaks something. By breaking something, it means that the level of interest is no longer supportive of the stock market, and it is now supportive of either being in cash or being in a bond. So until that happens, we can likely continue to go higher. And that is it. So I've tried to lay out my bull thesis and with more evidence this weekend. Instead of just saying, I think we're going to go higher, I think we're going to hit this area this weekend, I really tried to show you what I am personally looking at in my investment strategy. Because for the first time since the beginning of the year, I switched to being net long. I'm almost fully invested right now. I got some cash on the sides, 20, 25%, but for the most part, I would rather be long and wrong at this point than to be short. And like I said, I know exactly where I am going to want to fold out if I'm wrong. And that's a close below the 50 weekly moving average. That's where I start to get a little, that's where I would switch my status to a kangaroo, which means that we're just doing this again. And I don't really want to be in the market for doing that. Daily higher highs, daily higher highs, then weekly higher highs and higher lows, and then monthly higher highs and lows. If you watch charts, if you're a technical analyst and you're watching this video and you still don't know what that means, I would highly consider looking at something else for passive income, because the charts are screaming right now. Forget about the noise out there. There's always going to be noise. Look at the charts, focus on them, and try to do what I'm doing here. This base case should not be your base case. This is my base case for my investment strategy. I'm doing this for me, not for you. This is for me. This is for me to have an edge this week, so I also don't get caught up in the emotions. So if you think I'm wrong, make your own base case. What do you think the market's going to do? Where do I know that I'm right? Where do I know that I'm wrong? And with that said, I really appreciate your support. I look forward to seeing you on our regularly scheduled streams this week. Thank you very much, and good luck.